What if the stock market is not about money, but about belief, psychology, and collective expectations shaping economic reality every single day? Millions trade daily, yet few understand what actually moves prices, creates value, or destroys fortunes seemingly without warning. Stocks feel mathematical, but behind every chart are human emotions: fear, hope, greed, panic, and confidence colliding continuously. If markets were purely logical, crashes would never surprise anyone, yet history proves they always do. So what is the stock market really doing beneath the numbers flashing across screens worldwide? To answer that, we must rewind centuries before algorithms, apps, and financial television existed. Because the stock market did not begin as a casino, but as a solution to an expensive problem. A problem involving ships, oceans, risk, and money ordinary people could not afford alone. This origin story explains everything that followed, including modern bubbles, crashes, and speculation. Understanding this changes how you see markets forever. In the 1600s, global trade required massive ships traveling dangerous routes for months or years. The Dutch East India Company needed unprecedented capital to fund voyages risking storms, pirates, and total loss. One merchant could not absorb such risk alone. So the company offered shared ownership to private citizens. Investors contributed money in exchange for proportional future profits. Risk was divided, opportunity expanded, and participation widened dramatically. These ownership shares could be sold before voyages returned. This allowed investors to exit early or trade expectations. Coffee houses became informal trading hubs. Without realizing it, humanity invented the first stock market. The model worked too well to remain isolated. Other companies adopted shared ownership to raise capital efficiently. Governments noticed markets could finance expansion without direct taxation. Stock exchanges formalized trading rules. Shares became standardized, transferable financial instruments. Price reflected expectations of future success. Markets began valuing not current profits, but potential growth. Speculation entered the system naturally. Optimism pushed prices higher. Fear reversed them just as quickly. Industrialization massively increased demand for capital. Railroads, factories, and utilities required enormous upfront investment. Banks and exchanges became economic arteries. Stock ownership expanded beyond elites. Markets linked savings to industrial growth. Prices signaled where capital should flow. Successful companies attracted more investment. Failed companies lost funding. Markets rewarded efficiency and punished weakness. In theory, this created progress. A stock represents partial ownership in a company. Buying a stock tells the company does not receive money directly. It buys shares from another investor. Price changes reflect supply and demand for ownership. More buyers push prices higher. More sellers push prices lower. News shapes expectations. Expectations shape behavior. Behavior shapes price. Price then reinforces belief. Markets function smoothly while confidence remains intact. Trouble begins when doubt spreads. Bad earnings, scandals, or economic shocks trigger selling. Selling lowers prices. Falling prices scare more investors. Fear feeds on itself. Liquidity disappears. Companies lose access to capital. Layoffs follow. Economic damage spreads beyond markets. Market crashes affect pensions, savings, and employment. Ordinary people suffer consequences of abstract decisions. Governments intervene to stabilize markets. Central banks inject liquidity. Interest rates are reduced. Bailouts prevent systemic collapse. Moral hazard increases. Risk-taking resumes eventually. Cycles repeat. Lessons fade with time. Regulations increase after every crash. Safeguards promise stability. Financial innovation adapts around rules. Complexity grows. Transparency decreases. Markets become faster and more automated. Algorithms trade in milliseconds. Humans struggle to keep control. Speed amplifies volatility. Fragility increases silently. Today's markets operate globally, instantly, digitally. Trillions move with keystrokes. Retail investors now participate via apps. Information spreads faster than understanding. Social media influences market behavior. Hype creates bubbles. Panic accelerates crashes. Technology amplifies human psychology. The core mechanism remains unchanged. Belief still moves prices. Takeaway 1. Markets price expectations, not reality. Takeaway 2. Confidence is the system's foundation. Takeaway 3. Volatility is unavoidable. Stocks are tools, not guarantees. Long-term thinking beats emotional reactions. Understanding reduces fear. Ignorance magnifies risk. Knowledge restores control. Subscribe to understand markets before emotions decide your financial future.